Another strong week for the precious metals complex with monetary spot prices peaking in the middle of the week. On Wednesday, the spot gold price briefly eclipsed the important 1550 level. It remains to be seen if gold is going to make a run for 1,600 or need some time to gather energy. After a strong Thursday spot price sell-off, gold appears to be on pace to close the week above $1,520 per troy ounce in fiat Federal Reserve notes. Look at the top of your screen at SD Bullion or Silver Doctors to see if it indeed did so. The spot silver price on Wednesday, too, popped over the 1950 mark. Selling off on Thursday, silver appears to be ending this week below the $19 per ounce handle in fiat Federal Reserve notes, and the gold-silver ratio briefly pierced in the high 70s this week. Now, for those technical momentum traders who use the GSR as a timing tool, this is perhaps bullish short-term for silver spot prices to come versus gold. Platinum keeps chugging along higher, likely closing around the 960 per ounce mark, again in fiat Fed notes. That's to finish the week, and palladium has essentially been moving sideways since the other three major precious metals have moved out of their price slumber this summer. Palladium looks to be closing around $1,550 per troy ounce this week. Turning to our guests, it was 1 year ago that we got to speak with Ned Naylor Leyland in London. I spoke with him yesterday, Thursday, September 5th, about the big changes in financial market sentiment since the last time we spoke. We especially focus on the silver market, and most importantly for precious metal bulls, we discuss what are the coming catalysts which will drive a raging bull market for precious metals. Who are the players, and what is the psychology that can tip the scales of heavy capital flowing into the precious metals arena? All that and more. It's coming up after this brief message from our show's sponsor. SD Bullion is a high-volume, physical precious metals dealer here in the USA. If you are acquiring an investment-grade bullion position, be sure to bookmark www.sdbullion.com/deals, where each and every week we source some of the best bullion deals for our over 100,000 customers worldwide. At the bottom right section of our website, you can also easily subscribe to our weekly bullion deals mailing list, where you will receive weekly notifications of valuable product deals that may be exclusive only to our SD Bullion mailing list. Stay tuned to sdbullion.com, the lowest price, period. Welcome to this week's SD Metals and Markets Wrap. I'm your host, James Anderson of SD Bullion. With us this week's returning guest, who we spoke with almost exactly 1 year ago from today. We welcome back Mr. Ned Naylor Leyland, a gold and silver fund manager at Merian Global Investors. Hey, Ned, thank you so much for taking time for us today.
Don't be silly. It's a pleasure. The markets are slightly better and more in our favor at the moment, so it's interesting to have another chat.
Yeah, for sure. And just kind of on that button, I suppose, I want to start and take you back a year ago. It was early September last year when we talked. Silver spot was around $14 an ounce, and the gold spot was in the $1,100, high $1,100 range. And obviously things have changed. There's been a massive sea change in terms of, the hawkish Fed was running its mouth in the fall of last year, talking about how there were going to be more more hikes. U.S. stock market index was hitting nominal new highs and looking extremely bullish still. Just the sentiment in precious metals in general was rubbish. And, on our end, we only really had hardcore bullion stackers who were listening and who were buying on the spot price dips. And so some things have changed, and I want to understand on your perspective over there in London, what are some of the key structural sea changes that you've seen?
Well, I mean, in terms of changes, there's improved sentiment. You're seeing a lot more institutional investors interested by the subject. I would say that the key shift is what I'm sure we did discuss last time around, which is exactly that, which is that the bond market had it wrong and the central banks would have to go loose again, which of course is the direction we're now in. So structurally things have changed in the market, but in terms of investment flows, it's probably the most interesting thing I can say is that we've had a little bit of an improvement. We've had some inflows. The fund I run has grown quite well, both performance and inflows. But really, people are still reluctant to jump in, and I think it's because, I mean, it's two things. Principally, it's because the asset class has been out of favor for such a long time during heavily momentum-driven markets that most people who aren't well appraised of the subject matter and why they need to do it are still reluctant participants. And when obviously, particularly the equities have gone up, a fair amount quite quickly, they're worried that they've missed the party and that they're nervous about jumping in at this level. So I think it's very interesting, and I think that's very, very good structurally and on a forward look that is the case, that it really hasn't been a broad-based participation move. It's been a technical rally driven by real interest rates dropping, driving gold and silver up in the cash market, in my opinion. And then, we're still waiting to see really mainstream, broader market flows to fall in behind that. I mean, you I'm sure you may not agree with that and have a view as well.
No, I'm just thinking in terms of, you're speaking to very large players and high net worth investors. And so understanding the psychology of those people is very important. And so I really appreciate that take. I mean, there's people out there on the retail side, who are they're getting excited. They're getting bullish, of course. Some of them are a little bit angry because they wanted to buy at cheaper prices for a longer time. But I mean, there's so many older people who've been in this industry for so long, investing and waiting this out. You kind of almost want it to start to play out for them so they don't pass away before they get to see some benefit to the bets they've made. And so I appreciate that, that you give us your perspective on the London side and at least on the institutional side, what you're getting. I want to swing this over if we can, because silver is something that our listeners are super interested in. I'm sure at your fund that silver is something that you guys are keen on as well. Obviously going from last year when we spoke from 14 spot to, we're almost at the point where we're threatening 20 spot yesterday. A little bit of a pullback today as we're speaking on Thursday, 4 o'clock in London time, 10 a.m. and Central time where I'm at. All right, so we're in the mid-18s in spot, but it looks like we may end up threatening 20 and going up near that 21 resistance zone at some point soon. I'm wondering if you have seen a little bit about this past summer, how much silver has been going into the ETFs. Have you any idea who are these various players who are moving into the largest silver ETFs? It looks like there's over 100 million ounces that have flowed into them in the last 3 months. I wonder if you're hearing any rumor or have any guess or inkling as to what's going on there.
I don't. I would be lying if I said I knew what the background to that specifically. I would tend to say that that's people diversifying their physical gold ETF positions into silver, trying to benefit from the beta in the least spicy way that they can. So my understanding of the institutional world would be that a lot of people still just want to own physical. They don't want to own gold and silver mining stocks, which I think is a mistake, but that's the way they see it. I don't think they really understand that these are just pure monetary instruments, and that the attribution in them is relatively low. Although obviously silver could double, triple, quadruple, and then maybe that's less the case. But I would say that what that would be a marginal flow out of the 1 times long gold products for people who want a bit more beta but don't want to be exposed to the mining equity space. But silver is on a different level. It's just turning the corner now. So what I think is particularly relevant are the CTAs, the pure momentum based products globally, and they've grown a lot in size in the last 5 or 6 years as well. By the way, there's a lot more money in these things than there used to be. And they pretty much, most of them are slower to get a sort of green light on something like silver, which has been effectively in a bear market for so long than you might imagine. They don't just switch because of a moving average cross or one particular technical signal. It takes quite a lot for them to turn around and go green. So while you may have seen some flows into the silver ETF, and I would be cautious commenting too much on that as well because I don't buy it. So I don't look at it that much. So my insights are relatively limited, but I do think that the CTAs, I think, are the really important component in silver on a forward look, because I think that they're gonna all turn green and they're all gonna start chasing the price higher over the next 6 months to a year. So from what I'm seeing and reading and speaking to people in the space, it's still not there yet. They're sort of turning from a long-term red light to maybe an amber light, and in due course will go green. They're not there yet, but I do expect at some point that will be something important to drive momentum higher. Obviously, this is not, this is different. This is the future space more than what we're talking about with the silver ETF. I mean, I don't look at the silver ETF that much. What are you seeing in that? What is your view? I know you're asking me, but I'm interested to hear what you think.
In the industry, there's a lot of us who are looking at the charts and trying to understand, well, what is happening with the spot price? Why is it gyrating higher? And trying to understand. There's a lot of speculation out there as to who the major players may be involved, and if you start going into like the speculation aspect, you start sounding like a crazy person because you don't have the evidence. But if you just simply look at the transparent silver holdings in ETFs, you see a flow of over 100 million ounces moving into things like SLV. There's a Deutsche Bank ETF for silver. There's a couple others. And just to have 100 million ounces just randomly float into silver ETFs over a 90-day period. I mean, a lot of people allege that silver is a tighter market than that, and so it kind of puts people who say such things into perspective. And then you also have extreme doubters out there who don't even believe the ETFs have what they claim. And I'm not one of those people in the camp. I choose to believe that those numbers are at least accurate, but. It's more important is that I just wondered if you had any insight into it, because it's just interesting right now to try and understand who these flows are coming from, and if it's just simply investors or high net worth institutions who are trying to get beta, like you said, trying to get leverage on the gold price. I mean, that's completely plausible. That would make a lot of sense.
I think.
Go ahead.
I think that there's more of that than one realizes. Yeah. The amount of 1 times long gold exposure globally is very, very high. Now, what proportion of that has access to physical, of course, is a different conversation, but they're all trying to expose themselves to the same trade, which is 1 times on gold. And if they are looking for the beta, as you'll call it, or beta here, to two nations divided by the same language, it makes sense to me that they would look at the ratio and say, here's an opportunity to do that. But look, I'm very interested by silver flows, and I think the key thing to understand is that whether or not they can find that silver and whether that silver's there, and that's a different point, but really just silver is incredibly flow sensitive generally, the price at least is. And what we've seen in the last 6 weeks, I would say, is some flow start to appear. Now, it's not a lot, but some has appeared, and so I think that's what's driving the ratio down. Where the physical for that kind of inflow into the silver ETFs coming from, I mean, frankly, where any above ground silver flows have come from in either direction for the last 20 years is a complete mystery to me, even now, having looked at it in enormous detail for 20 years.
Yeah. That's the God honest truth. That's a good point.
It's a complete mystery, really. I think it's because silver's so strategic, by the way, that's one of the reasons why this is so hard to unpick.
So Ned, I want to bring it back to an interview I was watching you did recently with Real Vision earlier on in the year. You were talking about how in local currency terms, it's very important to judge, precious metals in those terms. And, the British pound sterling, the once extremely strong British pound sterling, it was originally defined when it first came out as 12 troy ounces of silver for a pound. And now the price of silver in fiat pounds is near about 16 quid, right? So that's a 99.5% devaluation. I wonder, in terms of, the all-time nominal high for silver in fiat pounds is 28 pounds per ounce. You guys are, beyond halfway there, it feels. And, with the Brexit coming up, I mean, I know that you're pretty pointed in the sense that you don't think it's going to happen, but I mean, when you talk to someone locally about just the trend in general, about the fiat pound and how it's might be going to parity with the U.S. dollar, I mean, I would assume that people are a little bit worried. Maybe they're hedging with other currencies, but Does that not, I mean, when you talk to someone like that, when you say such things to someone, does that not hit them at least in the, maybe I should consider having some percentage of my assets into hard money?
Well, I think it would do if I brought it up that way. I mean, what I would, without sort of being too rude to my fellow professional investors, I think probably what you said is a little bit over their heads. Generally, what's easier is when discussing this is explaining the genuine monetary characteristic of both metals and making sure that people understand that they're not commodities, that they're monetary hedging, that the risk is in money, and of course that's what you're saying. And that they need to diversify their portfolios. And generally, people are pretty receptive. The thing that you said there is kind of more for the aficionado. It's more for the person that's already into it, I think, because we always, the likes of us, we always run the risk of being too eccentric and going off into too many kind of elaborate explanations. And I've learned that the hard way myself. So I try to keep it as simple as I can and say, and just explain that, people have a problem in their investments with correlation, or certainly in the managed money world, people realize that they have an issue with diversifying their portfolio. And that gold in particular has a sort of totally non-correlated feel. And actually a fund like the one I run, if you include mining actives, has a sort of powerfully more volatile, non-correlated feel in portfolios. And what you need to do really with people is front them up about this and say, look, do you want everything going all the same direction all at the same time?
Right.
Or don't you? Now, of course, obviously the answer is no. But then you have to front them up and go, but you have to accept that that's actually what you want. Because the thing about this asset class is it really will do that. And people find that quite sort of shocking when they see it as well in both directions. People have become so inured to the idea through QE and the nature of where we are in the cycle that everything moves together in these huge lurches that they find it hard to actually visually watch things behaving differently. But I find that's probably the best single thing to go through. Telling people that their fiat money is in the last 0.5% of its purchasing power, which of course is true, and very occasionally I do bring this up.
Sure.
Is absolutely right in certain circumstances, but you do run the risk of losing a good proportion of your potential audience by scaring them too much, because then they just put their hands in the air and go, I don't want to hear it.
No, I get it. That makes sense. You're talking more in terms of just a polite, less aggressive way of bringing it about and selling it. I get it.
Well, I mean, it took me a long time to learn that, by the way.
Yeah. I promised to get you out of here early, and I think that we're going to close it off on this. I want to look a little bit ahead and just think in terms of potential catalysts to come. Last time we talked, we talked about the investor thinking he has certain asset classes on fire in their pockets, thinking in terms of cash and bonds and money markets and stocks. When is that retreat into bullion really going to start hitting, and it's going to start getting sloppy, and you start seeing a mania start to presume? I mean, what catalysts do you think coming up may be the things that start propelling that?
Yeah, great question. I would tend to say, with the benefit of a little more experience now than before, is I would say it won't really be, I don't think it'll be a catalyst so much as just a price action, because people are just are manic in their behavior now. People get dragged in rather than anything else. So, I mean, I think it will be central bank policy, probably. I don't think it'll be equity market activity. So I don't think it'll be even the equity market hard. It will be the central bank response to it that will drive the price of gold and silver up, and therefore it'll be the price action which starts to drag people in. People's fear of missing out is greater than their fear of losses, in my view. So I think that's probably what does it. It's the fear of missing out thing, particularly people who are heavily benchmarked. So institutional world, the big money, the stuff that really moves it is of course is my world. It's my world that really moves it. It's not the retail side.
Sure, of course.
And they're all benchmarked, and they're all worried about each other's sort of investments and who's doing what. So it'll be the fear of missing out in the institutional world, driven by price action, that will be the thing that creates an uncontrolled environment down the line. I very much, of the view, of course, that will happen at some point. And I think that can happen quite quickly. And actually, where we've been lately is a good sort of insight into it, in as much as we just haven't reached that point yet.
Yeah,
we've had a push, and people are looking at it, and they're looking in, and they're looking at each other, and the people that are already in are very happy. And there are a few people who timed it very, very well and have benefited from this uplift, but they're very few and far between. And most people, I think, are either still not there with it or looking for a dip. And who knows, maybe even today and maybe a couple of days, and this might be a good dip for people to say, I've waited for a dip and I now want to jump in. I tend to think dips now are going to be pretty relatively shallow because, there are definitely people wanting to come in, but they're finding it very difficult to buy something which is just continually going higher day on day.
Sure.
But yes, so as what was it? Was it Chris Powell? Always used to say, price action creates market commentary. So I think it'll be price in and of itself which creates that kind of behavior.
All right, well, Ned, I really do appreciate you coming on this podcast, even though it was a little bit limited in time. I hope that we don't wait a whole another year till we get to speak with you again. Maybe make it a half year this next go around.
Yeah, no, that's absolutely fine by me. Just let me know, and I'll happily jump on another call.
Sure, Ned. And how can listeners out there find you? Is it with Twitter, or how would you like them to find you?
Well, yeah, I mean, you can find me on Twitter, or Merian.com is our business website. But generally, people find my rantings on Twitter at NedNL. As I say, look, I'm very happy, mate, to come back on in 6 months or so, and we'll do an update.
All right, Ned, I appreciate it. Thanks.